Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Let's get to the latest on trade, certainly those trade tariffs that we keep seeing coming from the White House. The latest U.S. trade salvo continuing to be dissected today. President Trump signing a proclamation that happened Wednesday at the White House to implement a tariff on auto imports and pledged harsher punishment on the EU and Canada if they join forces against the United States, expanding a trade war and really triggering some threats of retaliation.
What we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%. This is going to lead to the construction of a lot of plants, in this case, auto plants, and you're going to see numbers like you haven't seen.
All right, that, of course, was President Trump yesterday at the White House. With more, let's head there and to Bloomberg News senior reporter Jennifer Dlouhy, who is at the White House at this hour. Jen, lay it all out for our Bloomberg audience, how the tariffs roll out, what's the latest, and are there any exemptions?
Right. So the way these are constructed under the proclamation that the president signed yesterday, they will initially hit fully assembled vehicles, and that will start essentially on April 3rd. The tariffs will be collected starting at 12:01 a.m. that morning. They will eventually, as soon as May 3rd or by May 3rd, start covering imported parts as well. So, your engines, your transmissions, your auto components. The idea being there is that, White House trade advisors, the president, believe that the U.S., is doing a lot of assembly of foreign-made components in its auto plants and not enough a generation of those high-value parts themselves. So the idea of extending to parts is a bid to reshore more of the entire value chain. And importantly, while there is a bit of a temporary safety net for USMCA compliant trade from Canada and Mexico, it is only a very temporary reprieve after the U.S. government decides how to assess the U.S. components of imported cars from those countries. It will essentially assess the levy on everything that is foreign about them, even though obviously Canada and Mexico are part of a trade deal that was negotiated in the first Trump term.
Right. Then the president who's the president now, made a really big deal about that USMCA back during the first term. We've seen the president already, though, Jen, roll back tariffs that have been announced, especially with regard to our neighbors closest to us. Is there any chance that over the next month, these could not be implemented or they could be rolled back?
With this president, I think there's always a chance. We have clearly seen his willingness to negotiate tariffs, especially with Canada and Mexico. To be sure, the president yesterday in the Oval Office said emphatically that these are permanent. These will last his entire term. Even so, we now know that, it's been reported that there was a call between Commerce Secretary Howard Lutnick and Ontario's premier. And after that, the Globe and Mail reported that the province now expects the U.S. to lessen the impact on Canada. So there's certainly a lot of effort by countries and companies that are being affected by these or expect to be affected to get some kind of exemption or a dial down.
So what else is coming next week in the way of tariffs? It's really hard. Tim and I laugh. I know Bloomberg has done a great job of trying to keep
We have the Trump tariff tracker. I have it pulled up. It's a Bloomberg.com story.
Right.
Google it and you'll get right to it. It's really perfect.
But to say that, it is really great. But it's like stuff still kind of is coming and maybe more stuff is coming. So tell us what we should expect for, next week.
I mean, next week is very, very big on the tariff front. The president has been talking about April 2nd for weeks as being what he calls Liberation Day for America. He has promised reciprocal, apologies. He has promised these reciprocal tariffs that will essentially reflect the levies that other countries impose on the U.S., both in terms of direct tariffs, but also things like a value-added tax or even, regulations that act to deter the import of U.S. goods into their countries. So the idea is that those would be set to reflect kind of what, as he puts it, what they charge us, we'll charge them. Yesterday, he did signal some, willingness to be maybe more lenient. He actually said, these will be more lenient than people are expecting. So we'll see. We'll stay tuned. He also indicated that they would hit all countries right away, as opposed to just focusing on what he has considered the worst offenders, the folks he calls the dirty 15. We're also, by the way, expecting sectoral tariffs. He has threatened those on pharmaceutical imports, on imports of lumber, and on imports of semiconductors and chips. It isn't clear how those and when those will all be rolled out, but yesterday the president indicated that lumber is likely next week.
Well, perhaps to throw another, another variable in here, China and TikTok, and the way that there could be a rollback in tariffs or partly as a result of a negotiation strategy with TikTok. President Trump said he would consider lowering tariff rates imposed on China to secure Beijing's support for that sale of TikTok's U.S. operations to an American company. What do we know about that? How would that work? Is this just a negotiating strategy?
I think Trump clearly has shown that he sees tariffs as not just an economic tool and not just a tool of U.S. geopolitical might, but really, an opportunity to exact concessions from other countries. And on China, of course, the U.S. government is trying to, shepherd a deal that would allow for the sale of TikTok to a U.S. company. That deadline under a law that Trump extended, the deadline for, hits April 5th. Yesterday, he said, look, I'm willing to, maybe I'd be willing to shave some of their levies a little bit, shave the tariffs on China if they agree to the deal, because there is some kind of China approval component here. How that actually works, we'd have to see. But I think it's quite clear, there are concessions he wants from China on an array of fronts, including drug trade, and TikTok may be something he's willing to negotiate on.
Is it just kind of always live? In other words, there could be more, there could be less. That's kind of the environment, at least right now, that we're in.
It's very fluid. I mean, even yesterday, there was a lot of fluidity around the scope of the auto tariffs before it was signed. We didn't know if it was going to be parts. We didn't know if it was going to be fully assembled vehicles. And, even after these things are put in place, they can be changed many, many times over. Fluid, unpredictable. That's where we are.
Fast moving river. That's what it feels like. All right, Jen, thank you as always. We know you are super busy as well. Bloomberg News senior reporter Jennifer Dlouhy joining us certainly from the White House. All right, latest on tariffs. Now we want to kind of get to, so what does this mean potentially for the U.S. economy?
This on a day when we got another read on the U.S. economy for the final quarter of 2024. For more, let's go to Bloomberg Economics U.S. economist Stuart Paul. He joins us here in the Bloomberg Businessweek studio. A lot of places to start. We could start with fourth quarter GDP, weekly jobless, core PCE. We got an important inflation print tomorrow, the one that the Fed really cares about. Does any of this matter when we continue to see a president change his mind on tariffs or impose more tariffs and really appear not to be done with that process?
GDP doesn't matter as much. The unemployment insurance claims don't matter as much. I do think that the core inflation and spending items do matter a lot. So tomorrow we're going to get the February core PCE inflation report, the Fed's preferred measure of prices. We're expecting to see 0.35% month-on-month core inflation. That's about double the pace the Fed needs to run to get back to its 2% inflation target. And we're also going to see a major surge in spending, in part on the back of autos, which auto sales were terrible in January, major rebound in February. Why does it matter? Folks are looking out in the world and they're expecting to see tariffs hit, and they're pulling forward their buying plans. So in anticipation of future prices tomorrow, they're spending more today, which actually generates the inflation that they're expecting to see tomorrow, separate and apart from the cost push effects of higher tariffs.
Right.
So yeah, if you're the Fed, if you're consumers, if you're looking at the broad macro data, things like inflation and spending still do matter, separate and apart from what's going on in the West Wing.
You were telling me you're going to go buy 6 cars this weekend.
Yeah.
So then you get them before
maybe
the
even a
tariffs
baker's
are imposed,
dozen
right?
or something.
Yeah,
right?
Saturday's going to be beautiful. A great day to walk the lot.
Well, I've been thinking about this. Like, how do you, as economists and who look at the U.S. economy, what's the rule of thumb when it comes to tariffs go up this much? This is what happens to the U.S. economy, or this is what happens to inflation. How do you play that out?
So we have a broad array of models. We use a whole host of different methodologies, but what it really comes down to is looking at the size of the market that's being tariffed, the size of the industry that's being tariffed, the effective tariff rate, how much our effective tariff rate across all imported goods moves, and then we map that to GDP growth and to inflation. So if we look at what happened with autos yesterday, our effective tariff rate is going to go up about 2 percentage points. Not huge. We're still going to be running at an effective tariff rate of just about 5%. Not a big deal. What it does do is take about 0.2 percentage points off a full year of growth, and it boosts core inflation by about 0.1 percentage points. If we think about reciprocal tariffs,
right,
and what it could mean in the extreme, if we're looking at value-added taxes, if we're looking at non-tariff measures, and we're matching tariff rates with our top 15 trading partners, that's an effective tariff rate of about 35%, not 5%, 35%, which will shave off about 4 percentage points from growth over about 3 years. So when you start mapping into the aggregate, it could get to be some pretty big numbers.
So how do you map that against this idea that the president has, which is if we impose these tariffs, we will see a return of manufacturing back to the United States. We will see more economic activity in the United States as a result. Do you map that out?
We do. The hit that consumers take and the consequences for consumption, it tends to matter more than the investment implications of trying to reshore additional manufacturing, getting people back to work. This is part of the problem with tariffs in general, is that some of the benefits, like investments, some of the benefits to auto producers, for example, are very concentrated, but the costs are actually very diffuse. And when they start racking up across the entire economy, they get to be some pretty big numbers.
One of the things I keep thinking about, Stuart, is that as we look to bring more manufacturing back to the United States, and I keep kind of asking, do we want to be a manufacturer of shirts? Not that there's anything wrong with being a manufacturer of shirts, but what is better for an economy, a developed economy? Is it better to be a service-led economy, high-tech? Like, what is it that's better from an economic standpoint?
For a developed country, being a services-oriented economy and being a consumption-oriented economy is really what matters. And when that's the case, you want to have low imported goods costs, right? You want costs to be relatively low. But there are 4 different factors, I think at least, that are in play when thinking about what could be motivating tariff policy, right? You have typical vintage Trumpism going back to the 80s where he's just looking at the trade balance and wants to win. You have Vance Midwesternism, I'm calling it, which is he looks out to the Midwest, sees the Rust Belt totally hollowed out and says, cheap imported goods are not the American dream. We need to bring hope and revitalize our manufacturing base to give people jobs. You also have defensive onshoring of major pharmaceuticals, for example, medical supplies, and that's a reason to onshore. And then finally, you have this negotiating tactic, this sort of monopsonist, we're the big market that everybody wants to sell into so we could extract rents from other folks. When all of those motivations are in play, we're still going to see tariff policy flying around. We're still going to see these proposals separate and apart from any sort of actual growth that we could generate. That's a secondary effect.
In your view as an economist, does this America First agenda when it comes to manufacturing in the U.S., does that work? Will it work?
In terms of generating growth?
Yes.
Fundamentally, no. Because if we think about the things so Carol, as you mentioned, do we really want to be manufacturing shirts? Not that there's anything wrong with that. It's a low value good. It's not going to do very much. The benefit to us of the additional manufacturing jobs in low value goods like shirts probably isn't there.
Right.
If you want to do some America First defensive onshoring of things like semiconductors, the amount of revenue that you generate per job created, or let's flip the ratio and say how many jobs are created per $1 million of revenue generated, you actually employ relatively few people. So we're not going to end up rebuilding a manufacturing industry that captures a large share of our labor force. It's just not going to happen.
Just 20 seconds, because that's like the question, I feel like, because we talk about the gaps that are here in the economy of the haves and have-nots. So what is it from an economist perspective really helps the U.S. economy benefit more in our society? And just really quickly.
Productivity growth. It's all productivity growth, not reversing the deindustrialization of the past century. It's productivity growth. It's capitalizing on new ideas and innovations. And that's why the U.S. has outperformed everybody else. It's mostly because of Silicon Valley and the development of modern finance in the U.S.
Killer stuff. So appreciate it. Stuart Paul. Yeah, that was like a masterclass. Folks, you missed it, download it.
Check out his research at Bloomberg Economics. Read all of the team's research.
Great.
They know what they're doing.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, U.S. mortgage rates in the United States fell for the first time in 3 weeks. Pending sales of U.S. homes rebounded 2% in February. So that beat economists' estimates due to calmer weather and a greater selection of houses. And then you might recall earlier in the week, sales of new homes in the U.S. bouncing back slightly last month. That was kind of after a rocky start to 2025. Home builders benefiting again from better weather, while also leaning on generous sales incentives to stoke demand, Tim.
Despite the rebound, home builders are cautious due to increased home supply, high mortgage rates, prices also, which may limit support for the economy. We got a great voice on this. Back with us is Katie Hubbard, Executive Vice President of Capital Markets at Walton Global. It's the privately owned asset and real estate investment company. It's got nearly $4.4 billion of land under management and nearly 90,000 acres under management here in the U.S. Walton Global operates in the retail, industrial, and commercial sectors. Katie, welcome back. It's good to see you. Usually you join us from out west. It's good to have you here in New York. Tell us why you're here, who you're talking to, and what the temperature is of the folks that you've been meeting with.
Yeah, so specifically meeting with some of our clients and also just attending a private equity real estate conference, meeting with some of the top national home builders as well, and just getting the sentiment that home builders are still feeling very bullish right now.
Why are they feeling bullish?
People are really settling into that mid 6% mortgage rate. And
settling into mid 6%.
Wow.
Didn't think I'd hear you say that.
Could be worse.
Yeah, it could be worse. It has been worse, but
and it could get worse.
So why else?
There's also a land grab going on in most major markets because land is scarce and home purchasers are still out there looking to buy homes, and people are really starting to come off of the sidelines. So they want to be prepared to be able to control the land, to be able to build the homes.
What makes home builders ultimately build?
It's a volume game. So the public home builders, they want to hit their numbers while protecting their margins. And as you mentioned, Carol, earlier, they are offering incentives still to keep those numbers going. And so you can still, buy a brand new house and get a mortgage rate buy down. Sometimes they're offering appliance upgrades, finishing kitchens with higher end granite, offering incentives to keep the volume going.
Because, I was thinking about, we were, getting ready to talk with you. Earlier this year, Bloomberg put out a story, and forgive me, I'm just going to look at some notes here. And they said they were looking into the nation's current housing crisis. This, I think, was in January. And they talk about the lack of home building coming off of the Great Recession more than a decade ago. Home construction never catching back up to the demand of a growing population. Zillow has put out some data, at least earlier this year, that the U.S. has a shortage of about 4.5 million homes. Is that still kind of where we are? And again, I think about what really needs to happen for housing affordability and availability to kind of meet some of the demand that's out there.
Absolutely. I mean, there is a shortage. So depending on how you look at it, could be, 4 to even 6 million homes short in the country. And so that's another thing that's keeping the builders going, is that the demand is still there. The regulation makes it difficult for them to build. So that's something that the Trump administration can do.
Remind us what that is.
And so that means there's a lot of bureaucracy and red tape when it comes to zoning and land development. So but
that's local.
It is local, but what the Trump administration has talked about doing is incentivizing local jurisdictions to make it easier to build houses faster. And then if they can build them faster, they can ultimately build them cheaper. So they can offer, federal funding and tax incentives to the local governments to bring that down. So, for example, in Portland, there was a developer who got an infill lot, and instead of rezoning it to build higher density, just was able to build 7 homes on one lot. And that's unique to Portland, but it's also an infill place where the land is expensive. And so just being able to offer that type of zoning where you can build more houses on smaller areas would potentially bring down the cost. For example, in Houston, one of the largest home builders is building 500 square foot homes, detached, selling them for $180,000. And then you can do a 2-story version for, around $200,000, which works in Houston because there's really no zoning laws.
And there's demand for that.
Exactly. It's so affordable. People, that want a house, they'll pay for that small of a house. But in most cities, the zoning laws would not allow for that type of development. Houston is just an anomaly. So we need to just make the zoning easier.
What are you hearing from home builders about potential challenges? Labor, given the crackdown on immigration, materials costs, given potentially a shortage, given that there's a lot of demand in Southern California post fires and rising costs due to tariffs. What are you hearing from them about that stuff?
Yeah, so the last 2 months, we have seen home builder surveys, and they're really not reporting any major changes in labor. So that is something that they're definitely keeping an eye on, but to date, nothing has really been affected. On tariffs, we saw the first Trump administration have 20% tariffs on lumber, and actually lumber prices didn't spike until 2021 under the Biden administration, and then they settled back down into the mid 600s per thousand board foot. So home builders, I was just talking to one of the luxury home builders, a national builder here, and they're projecting maybe $5,000 increase in overall home price for labor, but it's not. Wow. They're cautiously watching, but not really expecting home prices to go up for the lumber.
I think, Katie, one of the things that we've talked with you about is that how do we make sure it's not just about building homes, but building homes where we need them. And we've often talked about, this has gone on for decades, of major cities where it's expensive to live, but a lot of people work there, but they can't afford to live there. So how do we solve that problem?
Well, as we've discussed before, the administration has said, well, we're going to give federal lands out for development, which just doesn't work because those are going to be lands that are in the middle of nowhere, not close to job centers. And then just to go through the political bureaucracy of Congress, getting appraisals and the environmentalist, and then the developer ultimately has to be able to make money on that. That's not going to be land that's, in the middle of Alaska or Nevada where there's no infrastructure.
So what do we need to do then?
So again, it goes back to, hopefully rates will come down.
But rates have been lower, and we still don't have enough affordable housing in kind of some of major cities where so many people work.
Yes, and so really innovation is what's going to have to come in, and home builders are trying to find innovative ways to build. They're using modular, using structural insulated panels, so building off-site and bringing those materials on to reduce labor cost. But still, it's not going to. There's really no silver bullet.
I want to remind everybody: Walton Global buys land, holds onto it, and then sells it to the big home builders. How's land acquisition going right now?
Yeah, it's great. We're going into tertiary markets for our clients. So places like, we're buying in Panama City, Savannah, Georgia, Augusta, Georgia, Tucson, Wilmington, North Carolina. So not those primary or secondary, going to those next in line where land is still affordable. And that does help bring down the cost.
What's the most interesting trend in housing right now? Like, is the McMansion over? I'm just those kinds of things.
Yeah, I would just say the amenities. Really, home builders want to be able to build a home where you can have multi-generation, so that entry-level young family coming in, and then you've got the move-up house, and then you've got a place where mom and dad can, don't have to go to an assisted living facility, but they can have a single-level home in the same neighborhood. So they want pickleball courts, they want swimming pools, they want all of the amenities to attract that generation. And from the land side, you need a big enough parcel of land to be able to build a master plan community like that.
All right, master plan communities. Yeah, interesting. Katie, thank you. Thanks for coming back. Katie Hubbard, Executive VP Capital Markets over at Walton Global.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, a move by the Trump administration to block a $1.4 billion program for green building retrofits has left hundreds of in-progress affordable housing projects in limbo. Renovations for aging affordable housing projects across the U.S. have been halted as developers seek answers or alternatives. Now, the Green and Resilient Retrofit Program is one of a number of federal energy efficiency initiatives that Elon Musk's Department of Government Efficiency, DOGE, is looking to zero out, to the frustration of affordable housing developers across the country.
Austin Walker is undoubtedly watching what happens out of Washington closely. He's founder, CEO, managing principal at A. Walker & Company. It's a New York-based private equity fund manager, and it works with local firms in real estate management and development. He joins us here in the Bloomberg Interactive Brokers studio. Austin, welcome. I want to get to what's happening in Washington in a minute, but first I just want to get an understanding of what exactly your firm does, because I think a lot of people would hear private equity and affordable housing and say, wait a second, these two things don't necessarily go hand in hand.
Yeah, absolutely. Right. Affordable housing is, developed and, maintained and preserved through many different forms. Whether it's manufactured housing, single family rentals, tax credit development. There's, firms like us that really find unique opportunities to deploy flexible capital to really develop and preserve these housing opportunities across the entire landscape of affordable housing.
Which part of the landscape do you play in?
All parts of it.
So even housing that is regulated by the government?
Yes.
How do you make money in that?
A lot of it is fee generation. It's working through a lot of programming, working with local municipalities to program these opportunities, right? It's part and parcel construction management, pricing, and working with a number of different grants and set of programs. But it's largely driven really locally in terms of incentives and other programs available to basically, engineer a capital stack to create returns.
How much of your business or investment is in that area specifically?
I would say probably 20 to 30% is allocated to that area.
Is there any concern in terms of what's going on in the government that some of that gets cut back?
Yes, we got some favorable news. Last week was not so favorable. You saw the administration pass executive orders cutting CDFI funds, which are largely based on grants made through that to fund community development finance institutions, which are a large cohort of financial liquidity to the affordable housing space, and that in the form of loans, grants, other equity-like subsidies. But they passed a continuing resolution, which is again fully funding HUD, which is the largest provider of affordable housing through housing choice vouchers, Section 8 based project-based Section 8 contracts, supporting rents and affordable rents.
Have you already been affected by changes out of Washington in this administration?
Absolutely. I mean, we've had transactions that had to get repriced and stalled because, either our financing, opportunities, our lenders were either CDFI lenders, and programs are dramatically changing. If you were going in with a CDFI on pricing at an 8% fixed rate loan, and now you have to be going midway through a transaction at hard money to close a transaction because you have deposits down that are hard, you could be facing a 400 basis point increase in your cost of capital. These are real-time changes that are affecting the economics of.
So is that making you pivot in terms of different parts of your business, maybe spending more time elsewhere?
Yeah, I think for us, one of the things, we were born out of largely a market rate development shop that focused mostly on workforce housing and attainable housing. So that's really just housing at large, but more so C and B class housing, existing housing stock, which, at the end of the day, most of these policies, whether it's tariffs, immigration, other things, are going to affect the supply-demand imbalances, which are already extreme due to low housing starts. Especially coming out of the GFC. COVID, interest rates were so low, you finally got a little bit of a pop in development pipeline, but that's largely stalled due to the whipsaw in interest rates coming back up. So we look at that being a sustained problem, just given that tariffs are going to increase lumber prices, other inputs for construction, so construction costs going up. Immigration is going to affect labor supply and labor wage rates. These are already under extreme price pressures affecting the industry. And so we see a very big problem with deliveries, but that's actually good for existing housing, right? Because the demand is largely unchanged. And so, we probably are going to see inflationary pressure on rents as well, exacerbating the affordable housing problem. So it's quite complicated, and what's going on right now across the sector.
Katie Hubbard from Walton Global was just sitting in your seat about an hour ago, and she is in the city for meetings with her customers, who are the large developers of the land that her company sells to them. So the big home builders. She said they're not yet seeing increased costs due to materials. She says they're not seeing issues when it comes to labor. Why are they telling her that they're not seeing that, but you're seeing that?
So you have to think about it, I guess, from a larger industry perspective. Her end buyers, largely publicly traded companies, Pulte, the likes, right? They are not only mandated by their boards to use legal labor versus the private sector, which is able to tap into
Good point.
non-legal immigrants for labor. There's a big divergence between those, and they're such at large scale. They largely wholesale, bulk purchase, and warehouse their materials, whether it's overseas. Otherwise, they can navigate a large shift where you have tariffs on Canadian lumber versus bringing in cabinets from China at bulk, and they basically forward lock their pipelines, and they're able to price that out. They're not feeling it yet, but if this is a sustained, protracted tariff war that is more global in scope, it can make it very, very challenging.
But same thing with labor. I'm assuming those, who are, I guess, U.S. citizens or what, or they're going to have a certain labor pool, and I'm assuming those workers too are going to want their contracts with the big publicly held.
Yeah,
home builders.
absolutely, because there's certainty, but I think there's another element to it. Rental developers versus for sale developers. A lot of the Pulte Homes, Toll Brothers, the larger publics, they're home builders, they're for sale product. So they're not necessarily, worried so much about the input. They can largely, it's such a supply constrained market from a for sale, there's no inventory. So new deliveries are largely going to be able to bear the price inflation that's going to come out of increased cost of construction on a for sale product. But at the end of the day, financing, everything else as far as, multifamily rental product is largely driven by the confluence of interest rates and what you can charge at a nominal price per rent, plus inflating expenses across insurance and other things. So it's largely a cash flow problem. Inflation is going to really impact housing development because you're solving to a cash flow that at some point you can't inflate out of. So those starts get halted.
Hey, what do you see the federal government doing as far as making land available for building? That was a big part of the Trump administration's campaign. Especially J.D. Vance took that on and talked about federal land.
Yeah.
What do you see them doing?
It's interesting. I think it's something certainly that they've been exploring. It is absolutely a big need, but I think the biggest issue that's going to come out of it is what are the local economies around federally owned land that are actually going to support the economic drivers that are needed to sustain.
There's a lot of federal land out west,
yes.
But are there the industries to support people moving to that part of the country?
Yeah, I think that's the biggest problem, solver. The issue that's going to come up with federally owned land is how scalable is that for the capital markets?
Where are the projects that you are involved in? Where are they mostly located?
Yeah, so we largely identify opportunities in municipalities that are accretive to being whether it's pilot payment in lieu of taxes, tax abatements, other programs where you're getting property tax offsets in exchange for housing affordability on the rental side. So capping your rents on a certain percentage of our rentals. So we're in Los Angeles. Mayor Bass passed ED1. We just got a site approved there for vertical construction. We have acquisition preservation deal that we did in outside of Chicago, and that was a great transaction. Where we worked with Fannie Mae on that that loan, and got a 25% tax abatement on that for a very small set aside for rents. But it's largely a workforce housing area serving an amazing school district. But we're also in Florida, Houston, Atlanta, and we have projects that really are across the affordability spectrum. So
we hear a lot about how difficult it is to build in California.
Yeah.
Is that your experience?
Yes.
Is the California project that much more difficult than the other projects?
Absolutely. And we have another one in Long Island that we're looking at. Very similar. There's not a lot of parcels for development, and then the environmental red tape, the other local regulatory red tape, heavy politics in terms of permitting. Getting through that process takes an extremely well capitalized developer who has very, very localized expertise in working through the building departments to navigate that process. Even on a largely ministerial approval process, such as ED1, it still was very, very difficult and largely contested project to get through.
Austin, just to wrap up, who are the people that you're housing? I think there's maybe not an understanding of, who all accesses, when we talk about access, affordable housing, like who are they?
Yeah, they're everyday individuals. It's the folks serving you coffee. It's your waiters, your bus drivers, your teachers, firefighters, everyday folks, right? That are really going to feel the effects of, when a carton of eggs is $13 and a gallon of milk is $8. These are people that are really, making it paycheck to paycheck. That's largely the cohort that we serve. And that's why these programs are really, really necessary, because, what creates housing affordability in terms of the extreme lack of supply is local zoning. Until there is a federal sweeping ability, which is likely not going to happen in terms of zoning approvals for multifamily rezoning in commercial districts and everything, it's going to be really challenging to deliver the type of supply to actually naturally bring rents down. You have a small, test case in Austin, Texas, where they basically got rid of the permitting and zoning red tape. They delivered 55,000 units and rents came down by 25%. And they will absolutely absorb those units because there's an extreme need. That's a test case where you could, but doing that on a national level is going to be very, very difficult.
Super interesting. Thank you so much. Glad you stopped by. Austin Walker, founder, CEO, managing principal at A. Walker & Company, joining us here on Business Week.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, we're just about 18 minutes away from the closing bell on this Thursday. Bouncing around here, Charlie and Bill Maloney just, of course, breaking down the trade for you. Just a reminder, just down about 2 points on the S&P 500. Call it flat on the day. Dow Jones Industrial Average, a decline of 67 points, good for a decline of about 0.2%. Same percentage decline, Tim, when it comes to the NASDAQ 100, down about 43 points. But again, off our highs and lows of the session.
Yeah, I mean, the S&P 500 right now is not even down 0.1%.
I know, flat.
Yeah, it's like searching for direction, despite the fact that tariffs, I think, caught some companies off guard.
Yeah, it's kind of interesting, right?
Yeah, it's like, didn't this get telegraphed yesterday? I think the point that Jennifer Dlouhy made earlier was there was a lot of confusion about whether or not it would include auto parts companies, and it does. So you see those companies getting hit pretty hard.
Yeah, and then there's more to come next week. So I don't know. We've got an inflation print tomorrow. Let's see what Katie Nixon has to say about all of it. She's Chief Investment Officer at Northern Trust Wealth Management, joining us from Chicago. Katie, nice to check in with you. This environment, it's an interesting one, and sometimes markets react, sometimes they don't, but they seem to move around a fair amount. How do you describe kind of where we are and what's top of mind for investors and maybe your clients?
Right, Carol. Well, thank you so much for having me. And I guess I would just echo the sentiment that's been sort of persistent through your coverage, and that is just this period of uncertainty. I don't think investors really know which way to turn right now. The market today is a really interesting example where you sort of look at the averages, look at the bond and the stock markets, and you say, not much going on. But beneath the surface, there certainly is a lot of churn. So I think investors are looking for a guiding light here. They're looking for some certainty. And I guess what we're telling our clients is we may be waiting a bit longer if we're looking for that period of calm or more certainty. I think we're going to be living with more volatility and a lot more news and noise, frankly, that's going to impact markets for the foreseeable future.
What is the foreseeable future? How much longer? I'm getting a little tired. I'm getting a little tired.
I know. Well, I mean, we're all looking forward to Liberation Day, of course, but we're getting some pre-news here that's certainly market moving, and I'm not sure we're going to get the clarity that we probably need on April 2nd. And by that, I mean, I think it'll still be a work in process. I think we've learned through the last several weeks and months, frankly, that, news evolves over time, things can change. So it's very hard to have a lot of confidence in what you hear is eventually going to be what turns into persistent policy that won't change over time. So I think this is a time for investors to really sit back and recognize the one important thing, which is we're buying companies, right? We're not buying politics. We're not buying even economies. We're buying companies, and companies have showed remarkably through time the ability to navigate and to be resilient in the face of a lot of uncertainty. So although it's hard when you're reading the news and you're hearing about these things on a regular basis, it's hard to remind yourself, but it's important to remind yourself that at the end of the day, It's all about fundamentals, how companies are able to navigate this period of uncertainty, what the picture looks like on the other side. We don't necessarily know when we're going to get there, but we know we'll get there. And at that point, as an investor, what you really want to focus on is just the stability of the fundamentals.
Right. But the stability of the fundamentals can be whipsawed based on the headlines that come out of Washington. And so if we don't see things settle down sometime soon, does that once again make it hard to invest on the fundamentals?
It does to a certain extent, Carol, but I think, again, once companies know the rules of the road, they'll be able to navigate more resiliently. Right now, I think nobody knows what the rules of the road are going to be. Again, I use the word persistently because we might hear some news that could change, in a week or two. So I think we will be in this period of fog for a bit here. And I think we're actually going to hear more about that from companies as they start to talk about their first quarter earnings results. We're going to hear more about how they're thinking about the navigation process here as they are also facing this period of uncertainty.
Yeah, no, it's interesting. I feel like we just wrapped up earnings, right? They we're kind of just a few at the tail end, but I feel like we're already looking forward to earnings because we want to hear what the C-suite has to say about this environment. What are they doing or what are they not doing as a result of the volatility or the uncertainty going forward? In the meantime, so an investor comes to you and says, I've got a portfolio or I've got some money I want to put to work. What do you do with it today?
Well, again, there are always opportunities in markets. And what I would say is what we're seeing now is kind of a washout of sentiment. We see bearishness, in the AAII survey staying, pretty bearish for an extended period of time, which is quite unusual and typically precedes decent periods of return for investors. So what we would say to any investor that comes to us today, or frankly to our clients, get your strategic asset allocation in line and get yourself invested, recognizing that we're going to have a period of volatility, but also recognizing that as a long-term investor, this is not a bad time to be putting money to work in the market. But what we would say in addition to that, Carol, is start to think more globally. I think in the past several years, most investors have had this tremendous home country bias here in the U.S., and they've been right. The U.S. has roundly outperformed everything, and it's really been on the backs of U.S. large cap growth and in particular tech. We're telling our clients, and we would tell a new client, to start from a place of diversification. You want to have opportunities all across the world, and you also want to have opportunities away from just that super large cap U.S. tech focused exposure. And look at other areas of the U.S. market. Look at value stocks, for example, as an interesting place to get some diversification right now.
So, okay, U.S. and value, where do you view, I mean, look, nobody knows what's going to happen, but geographically, where do you see the outperformance this year?
Well, short-term, prognostications are incredibly difficult, but what I will say is we're more confident in the performance of non-U.S. markets today than we were 4 or 5 months ago. And that confidence comes from the combination of monetary and fiscal stimulus that we see coming really to the fore overseas. Clearly, you guys have covered Europe really well. We see, a really extraordinary amount of fiscal stimulus being injected into an economy and, more importantly, into a market that tends to be very sensitive to that. Right? Defense spending, infrastructure spending.
Katie, forgive me, just got about 30 seconds left. So do you want to commit a fair amount of money into Europe or not necessarily? Would you still stay with the U.S.? And just quickly, if you could.
No, you do, Carol. Absolutely. You want to be as diversified as the global market is and get your fair share of what could be some outsized returns over the near term as investors start to reposition their portfolios towards that opportunity.
All right, going to leave it there. Hey, Katie, thank you so much. Katie Nixon, Chief Investment Officer at Northern Trust Wealth Management, joining us from Chicago on this Thursday.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.